Hello, I'm MaryAnn. The Canadian dollar is fascinating to watch right now, especially as it defies expectations. I'm joined today by Shaun Osborne, who is Chief FX Strategist at TD Securities, and we're here to talk about the Loonie. Where is it going? What's having the most significant impact right now?
I think it's the general performance of the US dollar. We're seeing a generalized strengthening in the US dollar against a range of currencies, particularly in the G10 space. I think this reflects the anticipation in the markets that we're seeing a progressive move towards normalization of monetary policy in the US. We're getting very close to the end of QE. The US economy is actually doing relatively well at the moment compared to the other G10 economies, and that's actually underpinning the US dollar to a fairly significant degree, not just against the Canadian dollar, but against the euro and the yen and the other major currencies as well.
And is there any expectation that they will raise interest rates, say, in 6 months?
I think that's the window after we get to the end of QE that people are looking at. That's the kind of time frame that Janet Yellen early in the year mentioned as the potential time frame for rate increases to unfold. Assuming that the Fed continues with the current pace of QE tapering, QE will probably finish sometime later this year, probably around October. So that suggests that the first opportunity perhaps under that kind of timescale for a rate increase will be towards the middle of the year. In 2015. We rather think at the moment that it's likely to occur in the second half of 2015, but there is I think the potential for the markets to try and start to force the pace of rate increase, or at least force the Fed's hand, given the belief that the Fed may be behind the curve a little bit here. If the data keep coming in strong, rates are going to rise, and the market will take care of the rate tightening to a degree by itself.
Right. Now, what about in the Canadian space when we have our good job report, bad jobs report, whichever one you want to look at first? But where do you see that? How is that affected?
That was quite the mix-up. I don't think we've ever seen anything quite like that before, particularly in Canada. But it's very unusual to see a job report or a significant indicator like that restated to such a significant degree. So the initial report was much weaker than expected. It missed by about 20,000 jobs relative to consensus. The revision missed by about 20,000 jobs again, but to the upside. So it was quite a significant restatement. Interestingly, though, it hasn't changed that much for the Canadian dollar. We've actually, the modest rebound we saw in the Canadian dollar in response to the restatement has more or less unwound already. So we're trading back to 91.5 cents today. And I think the key issue for investors is a lot of the weakness that was evident under the hood, if you like, of the initial jobs report is still there, even with the restatement. And that's to say, an increasing reliance on part-time jobs in Canada, the relative decline of the full-time sector of the employment market, and the weakness in the underlying trend, if you like, in the data that was evident in the first report. So we tend to look at the 6-month moving average and the 12-month moving average because this is a very noisy series. Right. So to smooth out some of those bumps, we look at the longer-term moving averages, and it's been quite evident for a number of months now that when we look at the longer-term trend rate of growth in employment in Canada, this rate has been slowing. So even with this big restatement we still see the relative softness or sluggishness in the job market coming through in Canada, which contrasts, interestingly enough, with quite a steady and progressive improvement in the labour market situation in the US. So this goes back, I think, to the wedge issue that Governor Pollers talks about a lot for Canada. We're not really picking up to the extent that we would normally expect the Canadian economy to pick up, given the rebound in global trade that we've had and the recovery in the US economy that we've seen already. Now,
is that because we've been so tied to the commodity side of things?
I think it reflects a number of structural changes in the Canadian economy over the last few years. There's a lot of capacity being taken out of the Canadian economy that is not, you can't just turn on a switch and bring that capacity back. The commodity aspect is quite interesting. We're still a heavily influenced economy in terms of the commodity component of our economy here. Interestingly enough, though, we haven't really seen the Canadian dollar reflect the weakness in commodity prices that we've seen over the past few months. The CRB index, which is the basic benchmark of commodity prices, is down by something like 8.5% since the peaks we had in the middle of the year. Oil prices, WTI, has fallen by more than that, by almost 12% or a little more.
Why do you
even
think
with
that
that geopolitical tensions that we've seen. Yeah. I think for oil prices, it's a question of supply. There's an awful lot of supply out there, even with the focus that we've seen on the Middle East and Eastern Europe. Oil prices really haven't got much more momentum, or any upside momentum, in fact. And I think that reflects the fact that there's a lot of supply out there. When we look at what's going on in the US and the development of the domestic energy sector in the US is producing on a daily basis now more oil than it actually imports, and a lot of other areas around the world are ramping up supply. There's a lot of overcapacity within OPEC itself. We have the Iranian détente, if you like, which may eventually bring that supply back into the market space. I think there's a lot of supply basically out there that means it's going to be very difficult for oil prices to progress, even in an environment of global economic recovery.
So where do you see it going, say in the next year, the Canadian dollar?
Well, we're still negative on the Canadian dollar. We're generally bullish on the US dollar. So we're from around about 91.5 cents now. We see the near-term risk as falling to about 89 cents. Over the course of the next 12 months, I think we may well see something closer to 86 or 87 cents.
Oh, really? Okay, that's pretty significant. Now, is that fairly average compared with what the rest of the street says?
I think we're probably we've been on the bearish side of the Canadian dollar story for a while. I think we're probably still on the more bearish camp. I think the consensus has probably shifted a little bit more in line with what we're thinking at TD, but I think we're still probably at the weaker end of the scale, if you like, in terms of the overall outlook.
All right, well, thank you very much, Shaun.
You're welcome.
Always fascinating. I've been joined by Shaun Osborne, who is Chief FX Strategist at TD Securities. Thanks for watching.